clearly isn't going to provide enough for a comfortable life or make any meaningful contributions to the economy. Inflation also has the same kind of measurement problems, which can cause laggy or non-responsive results. Things like shrinkflation and shittification and the fact that housing costs are routinely underestimated means that even though on paper the consumer price index is only up by 30% over the past 5 years, actual everyday budgets are routinely being stretched even further. And it also ignores the bigger problem that even if inflation does go back down to the 2% targeted range now, that doesn't reverse the years where it was far higher than it should have been. Now, these limitations are very important to understand, but none of this by itself is anything new. So then, why are economists suddenly so worried about stagflation now? Well, for starters, there is a good chance that a lot of this information is only just catching up with us. As we mentioned earlier, a significant revision in jobs creation is a good sign that the real employment number may not be as good as it seems, even ignoring all of the problems of underemployment, which have clearly gotten more widespread over recent years with the proliferation of the gig economy. Economic growth is also becoming far more dependent on an increasingly narrow set of industries. Again, specifically in the USA, GDP growth has actually looked really good, but that's been propped up by a lot of government spending, a lot of big and probably not very sustainable investments into AI, and consumer spending. However, all of those carry with them significant risks. Obviously, US government spending relies a lot on US government debt, which has arguably been a problem for the last 2 decades, but might really be entering the find out stage now. New fiscal policy has lowered taxes significantly, while spending has remained roughly the same, even if it has been shifted around by cutting social programs, but increasing spending on things like defence and border security. Now, this isn't a straightforward budget issue because, of course, the US government can always print more of its own money, but that doesn't mean that people will value it. Now, sometimes all of the technicalities of how governments move money around distract from the simple supply and demand behind it all. Taxes are the ultimate source of demand for a currency. If people don't collect enough money to pay their taxes, they go to prison. So it's a pretty good demand driver. Lowering taxes naturally lowers that demand, and all other things being equal, lower demand equals lower prices. Now, the price of $1 will always be $1, but if the assumption is that there will be a lot more dollars floating around in the future, their actual value of what they can be exchanged for will be lower. Because of this assumption, people who lend money to the government will want more interest to make up for that falling value, or else they'll just go and buy something else right now. This is already happening, with major institutions and governments opting for alternative currencies and even things like gold to hold as reserves instead of US government bonds, which have an uncertain future. This means that the US government will end up paying higher interest rates for their borrowing, which with so much debt on their books will have a significant impact on the budget. Already, the government is seeing that when it goes to raise money by selling bonds, it's finding it much more difficult to get enough buyers. In the medium to long term, governments around the world that have been in a similar situation have had to resort to austerity measures, which means drastically lowering spending and raising taxes to start meaningfully paying off debt. This would knock out one major component of GDP, causing slowed or negative growth, and it would also likely come with significant increases in unemployment from laid-off government employees and contractors. The US has been able to get away with this for longer than most other economies would have been able to, because so many other countries use its currency for international trade that it effectively gets free demand from its currency from everybody else, not just its own people. But big international institutions and governments are not dumb. They are watching a growing budget deficit and erratic international policies, and they are reasonably surmising that this could make their reserves less valuable in the future, so it's better to get ahead of it now.